Good day. It is my privilege to be having a conversation with Stephen Cohen, who is head of the Europe, Middle East, and Africa region for BlackRock. He is a member of the Global Executive Committee and chairs the EMEA Executive Committee. He was also listed in Financial News' 2023 20 Most Influential People in Fund Management. So I'm delighted to be able to share his insights with you today. Stephen, thanks for joining us. Let's kick off with some of the key trends that you're seeing in asset and wealth management today, and how do you see these developing in the next 5 to 10 years?
Absolutely. Well, let me start by saying, Kingsley, it's great to be with you, and thank you very much for the opportunity to share some thoughts over the next half an hour or so. So I think this is a time of a lot of change across the wealth and asset management industry. You know, if I think about the wealth industry globally, but particularly here in EMEA, there are a number of trends that we're seeing that in many respects were, I think, accelerated by the experience of the last 2-3 years with COVID and everything that's happened over the last kind of 12 months as well. One of those trends is that we are seeing this ongoing shift from what we would call kind of products to portfolios. And what we mean by that is a real focus by wealth managers on how do you build these portfolios of the future. How do you ensure that your clients have portfolios that can withstand inflation, et cetera, and if you're in many parts of the world, not everywhere, where cash rates have been zero or even negative for quite a long time, and I can say that here in the UK, or if I look across much of Europe, you're now starting to have to think about how do you have portfolios that can deal with the reality that, you know, cash offers you a positive return. I know that may sound strange in some parts of the world, but for many of our clients here in Europe, that has not been the case for the last kind of 7 to 8 years. So we're seeing this kind of centralization of what we would call CIOs and this building of capabilities to really develop these portfolios and manage these portfolios. We're also seeing a shift in business model. So led by the US, we're seeing this move towards what is called fee-based advisory, which means the ability to manage a portfolio on behalf of a client, charge a fee for that portfolio rather than necessarily collect retrocessions. Again, that varies across the world depending on regulation in many respects. We're seeing a huge rise in digital. I think the big driver of what happened with COVID, or COVID was the catalyst for this acceleration in digital wealth. And digital wealth is coming in many forms. We're seeing new entrants coming into the market with new technology. We're seeing traditional banks now starting to respond to that by building their own digital interfaces to engage with clients. And we're seeing the overall adoption of technology across the whole of wealth management. And one area that we've seen a lot of that is upgrading of risk management, but also utilizing tools that allow you to manage your business, manage working with your advisors, ensuring that what they are doing is suitable, so you're meeting those regulations, but also scaling the business. I think scaling wealth management has become a big part of the trends over the last kind of 2 to 3 years. And within that, I think that when we look forward, and I think, again, look to the US as a good example of this, we're seeing more focus on personalization. How do you create portfolios that are very personal, that reflect people's values, particularly as you think about generational change? Here in Europe, how do you make sure that you're reflecting demands and desires for sustainability, which can come in many forms? And then finally, I would say that we're seeing, and we're having lots of conversations across the world, and particularly here in EMEA, about the role that wealth managers want to play and some of the functions that they traditionally done that potentially they're looking for a partner for. So this kind of concept of outsourcing non-core activities. And I think that lends itself to kind of what does that all mean for asset managers? And I think for asset managers, the big change is that from, you know, as our clients change, we have to change. And many wealth managers are looking for more from a fewer set of wealth asset managers who can bring a blend of investment management, can bring technology, ETFs, private markets, etc., in a way that helps wealth managers really grow the business over the kind of the next phase. So huge time of change, but also a lot of opportunity, I think, ahead for both the wealth and the asset management industry.
Yeah, it seems like there's certainly no shortage of issues that businesses and wealth managers and clients in the investment industry are going to have to grapple with to remain competitive over the next 5 to 10 years. But you touched on sustainable investing. I wonder if you're able to share some insights on rates of adoption of ESG or ESG-related strategies within the indexing space, and observations that you're seeing from a global perspective as that space unfolds.
Sure. Look, I think that I think when you're talking about sustainability, we're now seeing that in indexing. We're seeing that we're starting to see that in the active space as well. I mean, if you look at EMEA, there's about $2.1 trillion of assets sitting in sustainable funds, not just in indexing, but kind of across the range. Clearly, Europe is leading the way, and I think that part of that is being driven by regulation. You know, we've had regulation here, particularly in Europe. It's coming in the UK. SFDR, which is really driving that focus around labeling, et cetera. Those types of things, those types of regulations are moving the wealth management and the asset management industry more and more towards ensuring that there is a choice around sustainability. We're also starting to see real end investor demand across a number of countries. It does vary by country. Again, I think it's led very much by Europe, and in particular by the Northern European countries. And I think clearly we're seeing, Europe driving sustainability more so than arguably we're seeing in the US. So, if I look over the next 5 years or so, the forecasts are that we'll see that $2.1 trillion number become something like a $5 trillion number. So it is a huge growth driver of the EMEA industry. And I think that is going to be driven by, as I say, regulation, growing investor demand. It's also going to be driven by product innovation. And I think this is an area where the indexing business has really led the way, starting 3 or 4 years ago. And from an iShares standpoint, if I go back about 5 years ago, we really set out how do we help investors who are looking for sustainability make sure that they have the vehicles that they're going to need. And that started out very much as, arguably kind of screening out companies and exposures that investors didn't want to have in something like an ETF. But it's evolving quite quickly around how do you integrate it into some of these new strategies? How do you align with things like the Paris Agreement? And going forward, how do you offer clients the opportunity to have impact, which I think is going to be the next phase of what we're going to see from end investors who want to use their investments to see an impact, a tangible impact over time. And that's going to, I think, cut across index investing and also active and actually private markets as well.
Sure. Fascinating. I know BlackRock has really been at the forefront of driving stewardship and active ownership, particularly allowing end investors to actually express their views within your pooled funds. And I'm quite interested to hear, what the take-up of that has been. How active are you finding end investors in your collective investment schemes to be with this new development?
So it's a fascinating development. At BlackRock, we're very much focused on innovation. It's really been the heart of the firm for the last 35 years across everything that we've done. And voting choice, as we call it, is one of the most exciting innovations I think that we brought to market in the last couple of years. I think it's an area where when we think about what do our clients want, what do investors want, voting varies by investor, by client. But it's an increasingly important part of what asset managers do, and it's an increasingly important focus area for our clients. And so from our perspective, giving them the choice such that they can determine how they want their vote to be used, and again, whether that's something that they ask us to do for them, whether that's something that they ask another service to do, or whether that's something that they just want to do themselves. I think that choice is incredibly important. And up until now, we haven't had the technology to be able to do that, but now we do. And so, as I say, it's an incredibly exciting innovation. So if I look across our book of business, about half of our index assets are now eligible. On top of that, some of our scientific active equity assets are also eligible. And obviously, we want to grow that eligibility over time. But that adds up to about just over $2 trillion. And of that $2 trillion, just over a quarter of the clients in those investments have now opted for voting choice. So the take-up is strong. It's doubled over the last 6 months. and we expect it to grow exponentially from here. And we're going to learn a lot as we go through. But I think that ultimate goal of making sure that clients have choice, that they can exercise in the way they want to exercise using technology, is incredibly important to us. And I think, again, it's about how do we constantly innovate to help clients manage their money the way they want to.
Yeah, it speaks a lot to democratizing investing and utilizing technology, and even the word fintech to really bring about greater choice and empowering the end investor. And that's something that's very close to our hearts at Satrix as well.
It is.
Perhaps last question on the ESG side. There have obviously been some headwinds with regards to ESG, and there's always some criticism around ESG. Can you talk a little bit about how much of that is relevant and constructive versus some of it being misguided? And also perhaps touch on where you see the ESG landscape unfolding over the next 5 to 10 years.
Sure. Look, I think that we're living in an increasingly polarized and politicized world. And I think that one area where we're seeing a lot of politicization is in sustainability. So we need to think about what our right focus is, and our focus is on our clients. And if I look across our clients, I see clients who want to invest very heavily in transitioning their portfolios to be sustainable. I see clients who are focused on the net zero pathway, and they want to have a portfolio that reflects that pathway. So they've made commitments. They want to make sure they get and to deliver those commitments. I see clients who think of this in terms of the context of, I want to mitigate the risk of what sustainability and climate may mean for my portfolio over time, the kind of the risk of the transition. And as I mentioned earlier, we're increasingly seeing clients who want to think about their portfolios or aspects of their portfolios in terms of the impact that they can have through that investing. And we see clients around the world who don't want to have sustainability, or necessarily it's not an important factor within their portfolios. So I think the most important thing for us is to ensure that we are helping our clients achieve their goals. We're offering over 400 plus sustainable funds. And I think that choice is very, very important, because that allows investors to build the portfolios that work for their goals. And our goal is to help them, again, meet their goals. If I think about, this is about investing. And, we've always said climate risk is an investment risk. We think it's a very important aspect to consider alongside other risks that you traditionally think about in a portfolio. And incorporating it is going to lead to better risk-adjusted returns. And that's what our research shows if we think over time. So understanding those climate scenarios, understanding that transition, and then incorporating that into your portfolio and how you evolve your portfolio is incredibly important. I think that we're going to see the role of technology be absolutely central to this. Wherever you are on this journey, if you don't understand, if you can't see where you are and where you're trying to get to, you can't measure that, you actually don't know if you're succeeding. So we've invested, for example, very heavily within our Aladdin platform on technology, on data, to help clients with the transition that works for them, the transition that they want to do. The other thing I think we're going to see is we talked a lot about sustainability in terms of how do you take a portfolio, particularly here in Europe, and make it more sustainable. And clearly, I think that will, at least here in Europe, continue to be a major trend for our industry. But there's another aspect to this, which we're seeing around the world, which is the transition that the world is embarking on. Energy, biodiversity, agriculture, these transitions are going to require huge amounts of money. And they're going to require money that's going to come from the public sector and the private sector, and a way of working and frankly bringing that money together in ways that whereby, in particular, public sector capital catalyzes private sector to help do a lot of this kind of heavy lifting of finding the investments that will lead to the new technologies that will lead to the transition. That is, in our view, a fantastic opportunity for many of our clients. In fact, arguably over the next 2 to 3 decades, some of the biggest investment opportunities that we will see in the industry will be in these various transitions that require significant amounts of capital. So again, we're very focused on not just how do we help clients create these more sustainable portfolios who want to go down that route, but also how do we make sure that where there are opportunities for clients around the world to be part of investing in this transition to generate significant returns, that we're finding those opportunities and we're bringing those pieces of capital and those opportunities together. And I think that that's an incredibly exciting part of the investment management industry actually over the next kind of 10, 20 years.
Yeah, it's a fascinating space with so many different opportunities available and the ability to meet just such a wide variety of different needs and objectives. So thanks for your insights there. Perhaps if we can shift gear a little bit, I think there's undoubtedly, we're living through a significant transition in terms of how the global financial markets have shaped up over the last 18 months, with inflation coming back and central banks significantly responding to that with increased interest rates. So as a new investor playbook emerges, what are you hearing from investors, and where do you see opportunities both in the short and longer term as well?
Sure, I think that's an absolutely critical question, because I think we've written a lot about this in our BlackRock Investment Institute. We think we're entering a new regime, or we've entered a new regime. If we look back over the last 20 plus years, we've been in a regime generally around the world, not everywhere, of disinflation. We've been in a world where we've had incredibly efficient supply chains and this constant move towards more and more efficiency, just-in-time manufacturing. And actually, we've had a lot of ample supply, not just of supply chains efficiency, but also things like labor, right? Lots of migration around the world, et cetera, et cetera. And what that's meant is the job of a central bank has been to ensure that demand meets that supply. And so, when we've gone into a slowdown, central banks have cut rates, inflation's not been a problem, et cetera. We've suddenly, over the last 18 months, entered a new world. And that new regime, primarily for the developed world, is a regime where inflation is high, it is sticky. So if you look at services inflation, driven by wages, is sticky. So you have this kind of core challenge around particularly the kind of labor supply market. And these things are not going to solve themselves overnight. And so as a result of that, as an investor, you face a world which we've not had to face for the last 20 years, which is, again, this world of higher inflation, central banks suddenly going through this, the fastest rate cycle, hiking cycle we've seen since the 1980s. And as I say, in countries where you've had zero or negative interest rates, suddenly you've got 4 or 5% cash rates. So it's a very, very different regime. And it's a regime where you also have to recalibrate your expectations of central banks. So we've got used to the fact that when the economy slows, or there's a challenge in the economy or in financial markets, go back to 2008, go back to 2020 with COVID, that we have seen central banks react very quickly and cut rates. And I think what we've seen this time round is that that's no longer the central bank playbook, and that inflation does restrict their activities in that sense of coming in and immediately cutting rates. So what does that mean for investors? I think that for investors, it means that you've got to think very carefully about where you're going to go to find returns. I think for wealth investors, we're going to see a big increase of the use of ETFs. We're going to see this need to be more nimble, to think about making tactical views as well as kind of your strategic long-term view. We've seen a 4 times increase in ETFs over the last, since 2010. Since 2010, we think it's going to double again from here. I think we're going to see wealth investors look at private markets. So how do you diversify returns as well? And I think there's going to be big opportunities in things like infrastructure. Come back to what I said earlier on about the transition. That transition requires a lot of infrastructure. That's going to create opportunities. And I think wealth investors are going to be able to utilize those, because, again, you're talking about long-dated, high-income inflation protection, just the kind of investment that you want to make given the regime we just talked about. And I think for equities and fixed income, it just changed the game a little bit. We're seeing a lot more demand for kind of higher alpha equity portfolios, delivering that alpha, and in fixed income, this requirement to kind of go a little bit more unconstrained and making sure that you're finding sources of income above and beyond kind of what a cash rate can give you. And I think that's going to be the playbook as we look out over the next few years for for investors, and it's going to be a playbook where we're going to see a lot of opportunity. We're going to see a lot of technological development. I mean, we're very, very excited by what's happening in healthcare, where you have a lot of investment coming from the private sector, from the public sector, the search for new drugs, new technologies. AI is going to change the way we think about development of drugs, but also delivery of healthcare will change as well. So I think there's a huge amount of technological innovation that is going to drive a lot of investment opportunities, but it is a different regime at a macro level to the one that we've been used to over the last kind of 10, 20 years.
Sure, fascinating. And I mean, it's interesting what you've just touched on in terms of what investors are going to be looking for. And if I look at the flow numbers that you've put out, particularly now for March, we're seeing very, very strong flows across the board. What do you think are some of the reasons for that? And I think you have touched on some of the things you're optimistic about for the future, but perhaps you could elaborate a bit more on that.
Yeah, it's been fascinating the last 3-4 months in the ETF industry here in EMEA. I think it shows that we're at an inflection point. We are seeing structural adoption of ETFs here in Europe, and I used to run our iShares business, and in fact, when I first had the privilege of working with you was when I was running our iShares business, and we always used to talk about look at the US and look at the structural adoption of ETFs. And that's what we're seeing here in Europe. And even in a tough environment for investors, where we're seeing a lot of investors on the sidelines, investing in cash, waiting and seeing what happens to markets, we've seen a huge inflow of money going into iShares here in EMEA. I think what it tells you is that this is an adoption cycle. And that adoption cycle is about really the education around how to use these different tools. The fact that we actually now have a breadth of product that allows investors to build really interesting portfolios, anything from kind of government bonds and fixed income through to things like high yield, emerging market debt, through to individual countries, through to what we've got on the equity side, thematics, this ability to build really quite sophisticated portfolios of ETFs, these building blocks, which was not there a decade ago, now exists for investors here in the region. I think that's hugely exciting. And I would couple that with what I said earlier on, this growth of digital wealth and the emergence of neobanks, neo-brokers, the amount of money that we're now seeing whereby individuals are setting up accounts at their bank with a digital player, whereby they are able to put money into markets through ETFs. This is something we've never seen before in Europe, and it's something, as I said earlier on, that was really catalyzed by COVID. And I think it sets us in for kind of, in the same way we talked about a new regime for investing, I think we're actually in a new regime for the adoption of ETFs here in Europe.
Yeah, I would agree with you, and we're certainly seeing increased adoption of ETFs in South Africa. But I was wondering whether perhaps you could touch on, with your relationships across the world and the reach that you have, are you seeing any trends in other emerging markets, perhaps similar to South Africa, in terms of ETF adoption and how investors in those markets are using ETFs, and where there might be a few years behind, say, the adoption in Europe and the US certainly, but any observations in that space?
Yeah, it's interesting. I think if you take a step back, so ETFs are about 5% of the investable assets in the world. So, again, I think the growth story of ETFs globally is incredibly strong. And bear in mind, that's tilted very much to the US, where, adoption and penetration is significantly beyond where we are here in EMEA or in Asia Pacific. And I think when you talk to a lot of markets like South Africa and others, we do see similar trends. We're starting to see a lot of interest across other parts of Africa. We're starting to see the growth of ETF adoption in the Middle East, in a number of countries there. And we've seen the story in the Asia Pacific region. So again, I think the underlying demand is the same. What you're really seeing is for wealth managers and institutions, they're looking at ETFs as a very efficient, very flexible vehicle to build great portfolios for clients. And we're seeing that blend. This isn't an ETF or something else. This is actually incorporating ETFs into portfolios alongside very successful alpha-driven, kind of alpha-seeking active portfolios. And over time, we'll see private markets come as part of that as well. The other thing we're seeing, and I actually think this is going to be very, very interesting for countries like South Africa. This digital piece is huge. And actually, if you take for a moment Germany, in Germany, what we've seen is the development of what is called the ETF savings plan. And what this means is that kind of every month, a client, an individual would sign up for this savings plan, and every month they'll put 10, 50, 100 euros into the savings plan. So it's very similar to the way you would have saved, into a bank account back in the old days. But it goes into an ETF or a portfolio of ETFs. There are now 5.5 million people in Germany who have an ETF savings plan. The growth is huge, and I think that type of innovation is the type of innovation that we're going to see in places like South Africa and other markets and other emerging markets, where actually they become really efficient vehicles for investors to save. It's digital, it's on the phone, it actually ties to the way technology is being adopted in many countries around the world. That actually, in some respects, like take somewhere like India, we're actually seeing digital adoption in India kind of jump ahead of some of the markets in places like Western Europe, because there isn't legacy. And so I actually think there's a great opportunity to use the new technology rails, the new financial rails, to accelerate ETF adoption as the vehicle that helps investors save for the future and save for their retirement.
Yeah, digitization really enabling newer economies to almost leapfrog some of the legacy ways of doing investing and investing in the markets.
I think that's absolutely right. And
yeah. Great, thank you, Stephen. Maybe just to end off, I believe you do have South African roots, so maybe you can share a little bit about that. But also, any global perspectives and observations that you feel are relevant to South African investors at this time.
I do. I was born in Johannesburg, so very proud of that. Grew up here in the UK, and I have to say very jealous about the blue sky behind you right now in terms of the weather there. Even as you move into the winter and we move into the summer, we always seem to be slightly below on the temperature scale. But look, I think that Larry Fink, our CEO, recently wrote in his letter. He talked about hope and retirement, and I think that those two things are very relevant for many countries around the world, and in particular South Africa. And I know that Sanlam and Satrix are doing a huge amount around how do you give investors hope, how do you plan for retirement, and that's really central to the way BlackRock operates, and our belief and our hope is that we can, working with you and others, that we can do that for South Africa, because I think that providing retirement opportunities and the right in retirement is one of the biggest challenges that the world faces around the world, and we're going to have to work very, very closely together to find the right solutions for people. And that is the type of thing that's really on the minds of global investors, and I think on the minds of probably many of your investors there, is how do you provide these financial futures? And I think through education, through providing the right solutions, that's what we have to do together. And I think that's incredibly relevant for how we can help South Africa.
Stephen, thank you. Your insights have been tremendous. It's been fascinating listening to them and hearing what you have to say. And I hope we can do this again soon.
Absolutely. A pleasure. And I hope we can do it together in person.
Amazing.
And thank you for the partnership.
Thank you very much. Have a good evening.
You too.